It's been a bit of a crazy last, I'd say, 2-3 weeks as far as treasuries go. Well, there's a short and there's a long-term component to the rate story here. Now that it seems we've figured out what March looks like, could you tell us what the rate strategy would be between now and that March meeting of the Fed?
Yeah, absolutely. So we get the Fed meeting next week. I think that they're going to signal that March is already a done deal. The market's giving them that easy access, and they're likely to take it. And they certainly have pivoted to wanting to start the tightening process already. It really is a function of how hard they push back against the market's 4 hikes and talk about either 5 hikes kind of coming into the market and or a more aggressive start to the process. I think it's premature for them to get there because there's still a lot of data and a lot of unknowns that need to be cleared up before the middle of the year. So I'm still in the camp that we're going to get one in March, we'll get another one in June, and then we'll reassess. And there's still, again, a lot of questions as to whether or not the base effects around inflation, we don't use the term transitory anymore, but clearly inflation is expected to slow up as we get into the second half of the year, and whether or not that view changes is going to determine how aggressive they get in the second half of the year.
I mean, can they get any more aggressive? I mean, you talked about 4, maybe 5. I was going to ask the opposite, in fact, here. Do you think there is a downside risk to the number of hikes markets are talking about right now? Markets tend to overshoot, of course. It's the context there.
Yeah. No, I agree with you. I think there is a underappreciated risk that the market has pivoted too hawkish right now. They've gone, and the market's been right ultimately. Since the middle of last year, when it started pushing the Fed has kind of fallen in line with the view that inflation has been much more aggressive than they expected, and it's been aggressive the way the market had thought. So the market's going to continue to push this narrative, and the Fed at this point is dealing with relatively loose financial conditions. And they're not going to push that far against it until they need to, and it's the data that's going to drive whether or not they need to or not.
And Marvin, the question mark still remains around the shrinking of the balance sheet, right? It seems like the markets can handle maybe rate hikes, but we haven't seen the Fed undergo this, doing both in tandem. How disruptive will a faster and swifter quantitative tightening be this time around?
Yeah, I mean, that's probably the biggest challenge for me because we understand rate hikes a bit more. We've priced in a lot. We still have rate hikes in the long end, if you will, 2-3 years out, that's below the neutral rate. So financial conditions are still relatively loose from that perspective. But shrinking the balance sheet the first time around did not go that well. We've got a lot more liquidity in the system, so it might start fairly smoothly. But if the Fed gets aggressive because the market is pushing itself to get aggressive, particularly on the balance sheet side of things, and things don't go as planned, that's a bigger challenge. So the second half of this year, again, just listening to your opening segments, there's so much going on. I think that's what we need to strap our seatbelts on for at least the next several quarters, because there's a lot of moving parts here and a lot of unknowns from a point that we haven't really been at before. We've never had a balance sheet this large. We've never had a tightening into theoretically slowing fiscal and economic headwinds. There's just a lot going on.
Yeah. Marvin, the NASDAQ entering into a correction as well in the face of these rates that keep rising. I'm just wondering, I think I mentioned last time we talked to you that you are a long-term tech bull. Is that still the case now? Can you buy this dip?
You know what? I don't know if it's time to buy the dip yet. I kind of view a lot of this equity volatility as just a trimming of risk around a more hawkish view in the Fed. Globally, U.S. stocks have been loved for several years. It's prudent to pull back some of that risk and reallocate. One of the interesting things that I see is that while we've got volatility in the U.S. and we've got challenges in the U.S. equity markets, you're not seeing the same degree of concern in other equity markets around the world, particularly around the developed markets and even emerging markets. Emerging markets are starting fairly strong. So there is a reallocation away from the U.S., which really was pretty heavily owned, into other markets. So that liquidity story is still there, and I do think that growth is worth paying for. It potentially could get cheaper, but it's still part of your portfolio in my mind.